At RSM, we have over 40,000 great minds that take the time to find out what makes you and your business tick. Our audit, tax and consulting services are designed to help you move forward with confidence, but it's how we do it that sets us apart. RSM's experts take time to understand what matters most to you, which means you receive advice that goes beyond your expectations. What you'll notice is the lengths our people go to understand the hurdles that stand in your way, and then to find innovative ways to help you jump over them. That's the value of RSM. That's the power of being understood. In over 120 countries, there are RSM experts who take time to find out what makes you and your business tick. Wherever you are and wherever you want to go, our audit, tax and consulting services are designed to help you move forward with confidence. It's your ambitions we care about, and like you, our focus is on your future. The advice you receive may come from individual RSM experts, but it will be supported by our collective local and global knowledge, helping you grow and safeguard your future. That's the value of RSM. That's the power of being understood.
Selamat siang, Bapak dan Ibu. Pertama-tama saya ingin mengucapkan terima kasih atas kehadiran Bapak dan Ibu untuk dapat mengikuti webinar yang diselenggarakan oleh RSM Indonesia kali ini. Dan sebelumnya, perkenalan diri, nama saya Landung Anandito. Saya manajer transfer pricing di RSM Indonesia. Dan pada kesempatan kali ini, saya juga akan memoderasi jalannya webinar yang diselenggarakan pada siang kali ini. Baik, Bapak dan Ibu, sebelum memasuki ke pembahasan utama, saya akan memberikan sedikit pemaparan atau overview mengenai profil RSM itu sendiri. Di RSM Indonesia, kami percaya bahwa bisnis atau dunia bisnis merupakan suatu dunia yang cukup, landscape yang cukup dinamis, dan oleh sebab itu kami selalu memiliki komitmen untuk senantiasa memberikan asistensi atau pendampingan kepada klien-klien kami dalam menghadapi setiap tantangan yang ada, dengan tujuan tentu untuk future atau masa depan yang lebih baik. Dan oleh sebab itu, confidence merupakan salah satu filosofi yang ada di RSM Indonesia. Di RSM sendiri, apabila dilihat dari RSM Global, tahun ini RSM Global memiliki pertumbuhan di level revenue ya Bu, Bapak Ibu, sebesar 15% atau mencapai 8 billion USD. Dan kami, RSM Global, memiliki 830 kantor yang didukung oleh sekitar 57.000 professionals atau tim, dan tersebar di 120 negara. Dan apabila dilihat dari wilayahnya sendiri, RSM hadir di Afrika, kemudian juga ada di Asia Pasifik, ada di Eropa, di Latin Amerika, di Timur Tengah, di Afrika Utara, dan juga di Amerika Utara. Jadi hampir di seluruh dunia terdapat kehadiran RSM Global, Bapak dan Ibu. Adapun untuk Indonesia sendiri, RSM Indonesia sudah hadir di Indonesia dan kami sudah memulai memberikan asistensi pendampingan ke stakeholder kami, ke klien-klien kami sejak tahun 1985. Jadi sekitar 38 tahun yang lalu. Dan saat ini kami didukung oleh 700 professionals, 700 staff. Kami juga memiliki 40 partners dan memiliki 2 kantor yang ada di Jakarta dan 1 di Surabaya di Jawa Timur. Adapun mengenai jasa yang dapat kami berikan, Bapak dan Ibu, kami setidaknya memiliki 3 service line utama, ada audit, consulting, dan juga tax. Yang mana di audit kami dapat memberikan jasa mengenai AUP atau Agreed Upon Procedures, juga dapat memberikan financial information review maupun general audit. Dan di consulting, kami dapat memberikan jasa mengenai accounting advisory, corporate finance and transaction advisory, finance and accounting outsourcing, governance risk control consulting, management consulting, technology consulting, dan juga jasa-jasa consulting lainnya, sebagaimana yang diperlukan oleh Bapak dan Ibu maupun stakeholder kami. Dan adapun di divisi tax, kami dapat memberikan jasa dalam ruang lingkup bisnis tax, international tax, merger acquisition, dan juga transfer pricing. Dan kebetulan Bapak dan Ibu, pada kesempatan kali ini, webinar yang diselenggarakan oleh RSM Indonesia kali ini akan membahas topik seputar international tax dan juga transfer pricing yang bagi kami sangat menarik untuk dibahas. Di RSM Indonesia, kami juga percaya bahwa pemahaman terhadap klien kami, terhadap setiap stakeholder kami merupakan suatu hal yang penting. Dan oleh sebab itu, kami memiliki suatu filosofi yang kami sebut sebagai the power of being understood, yang mana kami sampaikan melalui adanya one point of contact yang akan diberikan oleh RSM Indonesia kepada setiap klien. Jadi ada semacam dedicated contact. Kemudian kami juga senantiasa untuk memperdalam pemahaman kami terhadap bisnis yang sedang di-handle. Kami berusaha untuk memberikan yang terbaik terhadap apa yang dibutuhkan oleh klien-klien kami. Dan juga kami berusaha untuk senantiasa memaksimalkan potensial yang ada. Dan tentunya kami akan selalu ada di sana untuk memberikan respons yang cepat dan tanggap atau quick answers. Baik, Bapak dan Ibu, pada kesempatan kali ini kita akan mendiskusikan updates terkait dengan international tax dan juga transfer pricing yang akan disampaikan atau dibawakan oleh salah satu partner kami, Bapak Salil Goyal, selaku partner di international tax dan juga transfer pricing. Dan topik yang dipilih pada kesempatan kali ini merupakan suatu topik yang sangat menarik karena perkembangan atau development yang ada di dunia mengenai transfer pricing maupun international tax begitu signifikan, sehingga kami rasa perlu untuk memberikan suatu updation mengenai baik dari segi technical maupun theoretical maupun juga practical. Adapun beberapa hal yang akan dibahas di dalam webinar kali ini, antara lain introduction dan juga legal framework terkait dengan transfer pricing, kemudian juga akan membahas mengenai OECD, model convention, yang nanti akan lebih spesifik ke artikel 9, yakni terkait dengan corresponding adjustment. Kemudian juga akan membahas perbandingan antara OECD model dan juga UN model yang nanti juga akan dikomparasikan atau dibandingkan juga dengan peraturan lokal di Indonesia. Kemudian juga ada pembahasan mengenai comparability analysis apabila kita melihat beberapa tahun ke belakang terdapat isu mengenai transfer pricing yang mendapat impact dari adanya COVID-19 dan bagaimana practical approach yang bisa digunakan. Kami juga akan memberikan semacam gambaran seperti apa yang dapat dilakukan. Dan juga tentunya perkembangan-perkembangan lain di dalam international tax dan juga transfer pricing baik di Indonesia maupun di dunia. Baik, Bapak dan Ibu, perkenankan saya juga untuk membacakan resume dari pembicara kita kali ini, Bapak Salil Goyal. Beliau merupakan partner International Tax and Transfer Pricing di RSM Indonesia dan memiliki pengalaman lebih dari 10 tahun professional experience di International Tax dan Transfer Pricing. Sebelumnya, beliau merupakan lead tax untuk International Operations yang bekerja di salah satu perusahaan di industri telekomunikasi yang berbasis di India. Beliau juga saat ini masih sangat aktif menjadi speaker atau pembicara di berbagai seminar internasional mengenai international tax maupun di kamar-kamar dagang atau commerce chambers yang membahas tentunya sesuai dengan spesialisasi beliau di cross-border taxation atau international tax dan juga transfer pricing. Beliau juga memiliki daftar yang cukup banyak mengenai penerbitan artikel mengenai transfer pricing dan juga international tax, termasuk juga isu-isu mengenai base erosion and profit shifting atau yang lebih umum dikenal dengan BEPS. Pak Salil juga mendapatkan Bachelor's Degree of Commerce dari Sri Aurobindo College of Commerce and Management dari Punjab University di India. Dan beliau kemudian melanjutkan untuk mendapatkan Executive Certificate in International Tax and Transfer Pricing di Leiden University di Belanda, the Netherlands. Baik Bapak dan Ibu, sebelum memulai sesaat lagi pembahasan utama, saya akan menjelaskan sedikit ketentuan di dalam webinar kali ini. Dan yang pertama, apabila Bapak dan Ibu memiliki pertanyaan, Bapak dan Ibu bisa menyampaikannya di dalam chat box yang terdapat di screen Zoom meeting Bapak dan Ibu. Dan pertanyaan dapat disampaikan dalam bahasa Indonesia maupun dalam bahasa Inggris. Karena memang pada kesempatan kali ini, pemaparan materi utama akan disampaikan dalam bahasa Inggris. Kemudian juga kami memohon untuk menuliskan nama Bapak dan Ibu dan juga organisasi Bapak dan Ibu. Dan kami harap pertanyaan yang disampaikan pendek, jelas, dan singkat, menggunakan bahasa yang santun, dan tentunya topik yang disampaikan juga relevan dengan topik yang sedang dibahas di dalam webinar kali ini. Saya selaku moderator akan memilih dan memilah pertanyaan-pertanyaan mana saja yang kiranya nanti akan relevan untuk dijawab oleh pembicara pada kali ini. Kemudian juga di akhir sesi webinar, kami akan memberikan link yang mana Bapak dan Ibu dapat memberikan feedback mengenai webinar kali ini. Dan juga untuk slides atau material, nanti akan dapat Bapak dan Ibu akses seusai Bapak dan Ibu menyelesaikan submission mengenai feedback form yang akan kami sampaikan secara terpisah di akhir sesi webinar kali ini. Baik, Bapak dan Ibu, mungkin tanpa menunggu lama, kita akan segera memulai diskusi mengenai International Tax and Transfer Pricing Updates. So, without further ado, Salil, I would like to hand it over to you for the presentation.
All right. Thanks, Landong, and thanks, Afri, for the introductions. And good morning, good afternoon. I see that some participants are joining. It's morning time for them. So thank you for joining us to discuss some of the transfer pricing and international tax updates relevant from Indonesia and Southeast Asia perspective. The backdrop of this is some of the recent regulations and the ongoing developments with transfer pricing, landscape in Indonesia, which has prompted us to, reach out to our valuable clients and colleagues so that we can share our perspectives on that and, can provide our view on transfer pricing issues and international tax issues in the context of Indonesia and other emerging countries. So I think, as Lamdung has already pointed out, that the format is that we'll firstly try to cover the topics, and in this webinar, I will try to equate how Indonesian regulations are, in line with the global regulations and best practices around the world. What are the, clarificatory issues that may arise, due to lack of certain, texts which can be prone to be understood in different ways. What do we believe? And some of the open concerns in relation to that. I think with that, let's start with the presentation. So this is the topics that we plan to cover. I'll probably start with a very basic, give you understanding of what transfer pricing is about, spend 2 minutes on that. And then we will discuss about where the guidance for transfer pricing is coming into various countries and how the global guidance is provided, where it is forming part of it, how Indonesia has implemented it, and then some of the new areas that Indonesia has touched in the last couple of years. What is the global developments on that? What are the open issues and challenges that we are facing with our clients and industry-wide issues in relation to that? Then we will discuss some of the adjustments which are very important from the perspective of Indonesia, which is a very commodity and manufacturing centric market, and this is kind of issue that we come across, and how we can tackle that in managing our compliances and resolving disputes in future. and then we will discuss about some of the COVID-19 implications that we are facing in the last 2 years, and how tax authorities are dealing with it. What is the guidance available? And I'll also help you understand what can be some of the takeaways based on our experience, not only with Indonesia but with developing and developed countries around the world. We are very actively discussing across Asia Pacific on how different countries are dealing with it, and maybe it would be something that that you guys can understand and see if you can leverage from that. Then we will also discuss briefly on some of the other methods which has been prescribed by the HAPAPE law in and where we think this can be implemented. It's a welcome regulation, and but yeah, so we will have a quick discussion around that. What are the prospective cases where it can be applied, and we'll end up with the MLI update, multilateral instruments adoption by Indonesia on various parameters. We'll just touch upon that, and this after that we will come to conclude and leave the forum for some open questions coming from the webinar or related to the topics that we have discussed. All right, and with that, London, maybe we can start. So the so the guidance for transfer pricing is coming from the Article 9 of the OECD Convention, OECD Model Convention, which provides for the rules for various countries to implement. As you know that in Indonesia, the guidance have been for approximately 2 decades now, but mostly the coverage was expanded to large portfolio of companies only starting 2016 when they reduced the thresholds, and more companies came into those thresholds, and that's when things have started to come for Indonesia. Similar is the scenario. In fact, there are many countries who are very recent in adoption of transfer pricing guidance. These include both developed and developing countries. So what does Article 9 say? Article 9, contains usually 2 paragraphs. In the first one, it deals with the circumstances in which transfer pricing adjustment may be relevant, where transfer prices are impacted by the relationship between the group companies. And para 2 provides that where there is a difference of opinion between the 2 countries on how the transfer pricing has been carried out, then in certain cases to avoid the double taxation. For example, if let's say one country, Indonesia, says that the company's policy is cost plus 3% for contract manufacturing, and Indonesia says no, it should be cost plus 5%. Then what happens that Indonesia is asking for 2% additional tax in the context of Indonesia. Then the paragraph 2 comes as a respite in treaties where it provides for corresponding adjustment to be provided by the other country, let's say the US, and then that country should allow the company to claim additional 2% expenses. But we will have a larger discussion later in the presentation on how this has been practically implemented by various countries. One. So a very simple example. Let's say the why transfer pricing is relevant, because that many companies are operating in a diversified way across the globe. So you will have countries. You have known that large companies are present in sometimes more than 100 countries. So they can have an opportunity to streamline their operations in a way that they accrue more profits in countries with the lower tax rate compared to higher tax rates, which will improve the tax rate for the group and effectively lead to higher profits for the company. So transfer pricing here comes as a compliance for those companies to ensure that the arm's length price is maintained, so that it does not impact the domestic competition in the countries. So in our example, let's say country A has a tax rate of 40%, country B has a tax rate of 10%. Now country A is buying from outside suppliers at a cost of 100 and then selling it to the parent company at a 10% markup. And then the parent company is ultimately selling it to the customer. So this is where they are taking the ownership and getting contract, let's say a contract manufactured from country A with a 10% markup, and then they retain 140 of profits. So in this routine example, the profitability will also be like that. The profit for country A is 10, country B is 140. So this leads to 140 of the profits being taxed at 10%, and only 10 is taxed at 40%, which is the higher rate, leading to an effective group tax rate of 12%, which is more than country B, but way less than country A. Now, in order to avoid this kind of situation, transfer pricing comes. So what happens that arm's length price is to be maintained if this is, let's say, governed by structures where the subsidiary is playing in our example, is playing a major role in the performance of business functions and is contributing to the a bigger hand to the generation of 250 of revenues to the customer. So let's say if in an arm's length scenario, the if the subsidiary is playing a higher role, then this cost structure or this P&L will be revised. So this will lead to only 50 of profits remaining with the parent company and attributing 100 of markup to the subsidiary entity based on the functions that they perform, assets they employed, and the risks they undertake to perform the core functions or main business functions of the entity. So with this, the distribution of profits will differ. Now 100 will be taxed in the country A where there is 40% tax, and 50 will be taxed in country B with a 10% tax. So the group tax rate comes to 30%. So this is the broad context of transfer pricing. I know most of you might already know, but just wanted to set the tone with a very small example before we move on to the more complex topics, because today's presentation covers corresponding adjustments, secondary adjustments, which are very tricky. And but now that Indonesia has implemented, so we all need to learn about how they function in practice. Right. So this is you can see that how the what is the scope of how the scope of tax varies based on the transfer prices between the subsidiary and parent, if it is not under remunerated or not correctly remunerated. So it has a very high tax exposure. Next. So this is coming from Article 9.1, which talks about intercompany relationship. The previous slide was coming from Article 9.1, which says that if the transfer prices are affected by special relationship, then this needs to be recomputed based on arm's length price. There are other references to the arm's length principle in the OECD Model Convention. When we say OECD Model Convention, largely most of the treaties are based on those. So similar provisions you will find in the respective treaties also. Let me just, I think there are some participants looking to enter. I'm just entering them. Sorry. Yeah. So Article 7.2, which talks about the permanent establishments, branches, it says that this covers the arm's length price to be maintained when you deal with the permanent establishment. Article 11, which talks about interest. So interest is again with the intercompany loans. It also provides that these should also be at arm's length price, and same goes with royalties. So these are specific provisions. There are other references, but these are the major references that we see in practice. Next. So now we will discuss the recent regulation from PP 55 2022 that has come out recently, Article 35 and 3, and how it ranks with the global guidance. So I think the earlier provisions of related parties covered, the relationship based on control, capital, and management. So which is highlighted in point A in the income tax law, which covers that 25% of the equity. I think there is a typo. 25% of the equity between two or more taxpayers is if common shareholding, then it is part of related entity relationship. Then if there is control on the management directly or indirectly by controlling the board, or by having uh, key ownership on major business decisions, then it is also a case for special relationship, or for the purpose of applying the transfer pricing and arm's length pricing. Then third is through a family relationship in relation to point A and B. Then Article 35, has come up with, we have highlighted in blue. It says that transactions within special relationship, which includes affiliated transactions directly and transactions between the entities who do not have special relationship, but there is impact on by their behavior on the prices and transactions. So how the special relationship has been defined, that goes to Article 33 of the PP55, which mentions that the dependence, which mentions it to be a condition of dependence or attachment caused by ownership or participation of capital or control or family relationship, similar points as I mentioned. And they also mention some of the cases of deeming control, which occurs as a relation of these points. Some of the key points which has been added is highlighted in blue in the article, which mentions that the parties may be commercially and financially known to be part of the same group. If out of the overall group, if two entities who do not have a direct relationship but their transactions are influenced by a commercial or financial relationship between the overall group, then this can be said to be exercising a special control liable for transfer pricing. And second is when they have special relationship with each other, owing to, let's say, one entity has the ownership and control, but they are also owning stake in another entity, through which they are conducting the business in the third entity. So one entity has common control, but they don't have direct control, but they do business or influence the suppliers' business decisions. Then this is also part of special relationship and will be tested for arm's length price as per the Indonesian regulations. Next. So this is also similar to Article 9.1, which says that an enterprise which participates directly in management control capital. So we can say that Indonesian regulations has reflected on the guidance on OECD commentary on this. And then they also mention indirect also, where they say that same persons directly or indirectly can also participate in the management control or capital. So these both cases are subject to transfer pricing. We will elucidate this in the form of an example. Maybe, Landu, can you go to the next one? So this is the cases where this is in Latin, so we have just translated to English. The de facto control is, having a formal right, and there are cases where you may not have a formal right, but you may have an influence, and that also is covered for the purpose of determining the intercompany relationship subject to transfer pricing. We'll cover it through the examples. Can you go to the next one? So broadly, you can say that the relationships are in the form of vertical and horizontal relation. Just 1 second. Landung and maybe BD team, there are participants in the waiting room. Maybe you can just, periodically review and enter them. Okay. So vertical relationship is a case where, let's say, an enterprise in country A is having direct ownership in subsidiary in country B. So this is a case of vertical relationship through direct ownership. So it's easy, and you will have direct coverage of these transactions in the transfer pricing. And horizontal is when there is a common participating person who is having stakes in both the countries, and which may also influence the transactions between subsidiary A and subsidiary B, and subsidiary 1 and subsidiary 2 in country B and C. So the transactions at subsidiary 1 and 2, maybe they don't have, shareholding in each other, but they are controlled by country A. Then the transactions between subsidiary A 1 and 2 are also subject to transfer pricing, and needs to ensure that arm's length pricing and fair price dealings are maintained between the two. It also boils down to step downs that, let's say, common person having control in subsidiary 1 and 2 at country A level, and then those countries are engaged in, have a direct ownership in other countries, country B and C. It will still be subject to transfer pricing, because you will have to, because the rules cover for, direct or indirect ownership. This is what we were trying to elucidate, whether it is direct participation in management control or capital, or indirect. So the second case is a case where, the parent has ownership in subsidiary 1 and 2, does not have ownership directly in subsidiary 3 and 4, but through subsidiary 1 and 2, they have indirect ownership, control, or management in country B and C, subsidiary 3 and 4, then this is also subject to transfer pricing. Next. So the commercial and financial relationship with that, that Indonesia has adopted recently in their language, I think that this is more of clarificatory, and from our understanding, it was always meant to exist even without the specific regulations. But this is more of a case where you can expect that if you did not account for these kind of relationship previously, now you need to be a little more careful. So it's an important statement that, maybe because we often see that sometimes clients, discuss and say that, they don't want to, they don't believe that because they have ownership or control, and they don't squarely fall in the definitions of related party transactions as per the Indonesian regulations. So these are more relevant to those companies who are taking aggressive view on whether, they should only be liable to report transactions which are influenced by, their direct ownership stake in management control, or they should also consider that commercial or financial relationship. For example, there could be a business where you are selling 100% of your output to one entity, to the group entity, and also you are purchasing a majority of your supplies also from that group. So, from an entity whose, but the decision to engage the supplier is also, also coming from the group. So you don't have independence in relation to that. So sometimes the party with which you are engaging for buying those goods, they can also be tested for, whether that is influenced by intercompany relationship. So you need to be more careful about those transactions, whether these are influenced, whether the commercial or financial relationships is influenced by a group company or those are independent. So these relationships needs to be taken care in more detail, in the coming times. Next. So I think this is again just a highlight from the previous one, that the conditions are made or imposed between the entities. So like, if the contracts are structured or the business is operated in a way that, for example, you have plenty of let's say, manufacturers in Indonesia. You are doing a contract manufacturing operation, and there are multiple sources of raw materials in Indonesia, but you import the raw material, and this is not, cost effective, or it is not quality wise. It's not a very prudent decision, and then maybe you need to then evaluate whether this is influenced by a group relationship, or is it an independent activity taken by the management of the local entity, because transfer pricing works on the premise that each entity should be independent in evaluating its arm's length condition and their business decisions. So if these are influenced, then you have to take a view that whether these can be said to be governed by intercompany relationship and subject to testing of arm's length price in relation to those transactions. Because in comparable circumstances, comparable and uncontrolled circumstances, you would probably take a call, based on your business drivers, whether it is quality, whether it is related to pricing or other things, or a combination of two. You will take a decision otherwise. So this is important. Why I'm saying important, maybe, you may not be able to clearly find the impact, but sometimes some businesses have a great influence that, the distributor, let's say you are supplying to a distributor in Singapore, who is also, and you are operating as a contract manufacturer, but sometimes the distributors are also playing a crucial role in determining your suppliers. So then you have to probably evaluate conditions, whether that decision of engaging suppliers is also something that needs to be reflected in your transfer pricing or arm's length pricing. And are you paying something in relation to that service to your distributors in Singapore, or let's say Philippines, or wherever? So these are important elements from that perspective, and we assume that the tax authority might also, is also paying more attention to those factors. Next. Then we go to Article 9(2) of the Model Convention, which contains about corresponding adjustments, provides the provision for corresponding adjustments. Though this is again a sovereign right and independence of the countries to decide. So we have seen that Article 9(2) is not provided in all the treaties, but OECD suggests that in order to avoid conflicts, you should have a provision of Article 9(2) so that there is reduced impact of, or no impact of, economic double taxation in between the countries. Next. So what does Article 9(2) says? I'll just do a very quick reading. It says where contracting state, let's say a contracting state is Indonesia, where I'll read contracting state of country is Indonesia, where Indonesia includes in the profits of them and taxes accordingly profits which has been charged to tax in Indonesia, right? Then, so let's say, you have transactions where Indonesia and let's say the other country, Hong Kong, is involved, where two countries are involved and Indonesia is the source country. The article says that the source country, if the profits are subject to tax in the source country, based on its rules and the treaty regulations, then Hong Kong should accept that and make appropriate adjustment to the taxes charged on those profits and give its fundamental taxability in Indonesia, and accordingly ensure that the double taxation impact is minimized. Just to give you an example, let's say Hong Kong is the distributor, a fully fledged distributor, has manufacturing operations in the form of contract manufacture to Indonesia. Indonesia is, from a policy perspective, Indonesia is operating at a cost plus 4%, and selling all its output to Hong Kong, who will then distribute to Asia and other countries, as they are maintaining the market relations and everything. Now, if based on the functions performed by Indonesia and the comparability analysis, supported by benchmarking, if Indonesia tax authority and believes that this is subject to 6%, so the policy is cost plus 4, but let's say if the arm's length price based on the comparable company's earnings suggests that it should be 6%, then 2% Indonesia will charge based on Article 9.2 says that it is taxed according to and charged to the tax in that state based on the profits accruing to that state. Then the other country should make provision for that adjustment. So Indonesia will accrue additional 2%, and similarly Hong Kong is expected to give additional allowance of 2% in the books of Hong Kong for this expenditure incurred in relation to the transaction of contract manufacturing with Indonesia. So this is what Article 9.2 says. We will discuss more detail with some examples for the understanding. And from an Indonesian perspective, can you go back? Indonesian, we have not reproduced, but Indonesia has similar concept and provisions contained in the DGT Regulation 22 and the Circular number 50. And this is both for corresponding and the secondary adjustments. Go down. So what does Article 9.2 say? It's more of a technical reading. I'll just quickly state because the definitions of the terms like enterprise of that state, which is the contracting state, is defined in Article 3. Conditions are also coming in the Article 9.1, which says that conditions which impact the price, which impacts the enterprise, which would have if they had done business independently, would have agreed on different pricing criteria, but the conditions are made between these entities which influence the price, then arm's length price should be maintained. And then the corresponding adjustment. This is just not just an elucidation of the previous slide that I was trying to explain, that the corresponding adjustment should be provided if the primary adjustment is accepted in principle as well as the amount. I'll come to this, the commentary para 6, because the key words here is corresponding adjustment is due only if the contracting state considers the primary adjustment justified both in principle and as regards the amount. So in our example, when I mentioned about Hong Kong, so the Hong Kong should also accept the transaction in the same way. So basically, if I say that, what is the, I'll just zoom out on these provisions. It says the primary adjustment. So what is the meaning of primary adjustment? Example of contract adjustment, manufacturing. We talk about the sales price from Indonesia to Hong Kong for the contract manufacturer. So the Hong Kong tax office or Hong Kong authorities should also accept the sales price by Indonesia or purchase price by Hong Kong as cost plus 6%. Then only the corresponding adjustment will be allowed will be accepted and will be covered under Article 9.2. So it says both in principle. Principle means in the same way as the transaction has incurred and at the same amount. We'll again touch upon this in through some examples. Next. So this is interesting to note. I mean, this is something that we, interesting for you guys to note, that the provisions of Article 9.2 was not initially, was not always present. So like, most of the treaties were, started to happen in the context of Indonesia in the 1960s and, 70s. But the 1963 OECD Model Convention did not include Article 9.1. It is only in 1977 that this clause was added. And usually, just digressing from this, most of the tax treaties that, especially from a developing countries like Indonesia's perspective, we rely largely on OECD Model Conventions and UN Model Convention and practice of some of the other bigger nations, and that's how we adopt it. So you can assume that treaties which are signed before 1963 may not have an Article 9(2), and in those circumstances, if Indonesia taxes something, let's say in our example, with Hong Kong cost plus 4 to cost plus 6, let's say if Hong Kong treaty was signed before 1977, it is high chances that it may not have this provision of giving a corresponding adjustment. And we have found, I'm not sure about the dates, but we see that the treaties with Japan and Singapore, Japan and Switzerland, from Indonesia perspective, do not have Article 9(2). So if you're dealing with countries, with these countries, then if Indonesia makes a primary adjustment in the form of contract manufacturing price adjustment, then there is no opportunity for Japan or Switzerland expectedly to take credit of the extra income that if they plan to accept the adjustment from Indonesia perspective. So, and usually if you don't have rules, then the other countries may have a tendency of not adopting it and denying the deduction to the companies. So which will lead to the bottom line, then it will be the cases of double taxation suffered by the taxpayer in both the countries. Okay, go to the next one. So that's the example that I'll elucidate through the example so that it becomes more clearer about the topic. So similar to previous slides, when I gave an example that let's say assume that an independent supplier provides to a subsidiary, there is a subsidiary in between, and then the subsidiary suppliers are doing business with another entity, and then they are selling it at 250 to the outside customer. Sorry, I think there is some problem with the slide, but I'll just narrate. So let's assume that the purchase price from the suppliers is 100, and the sales to intra-group is at 110. So you make a profit of 10 in the, let's say in our example, contract manufacturing entity, and then so subject to the same rules as 40% tax, you pay 4 of tax. Then the revenues are 250. Costs taking from the same, that you assuming that the country B does not have any other costs in relation to that, and so the entire cost is 110. Then the profits will become 140 for the transaction, which are subject to, in this case, 30% tax. We have just changed the example to, previous case we took 10% in country B. This year we have this one we have used 30%. So the tax in country B will become 42. So again, country A has 40% tax, country A has 30% tax, but by leaving lesser profits in country A, then the effective tax rate can be reduced by putting more profits in 30% tax rate and less in the country A. Now let's assume that this price is not accepted, or it is not at arm's length price. Then an upward adjustment is required by the rules of country A. It says that the country operations should deserve a higher adjustment, and then they say that the value of profit, the value of revenue that they should sell to the parent company should be 200 instead of 110. So in that case, the profit at country A will become 100, which will be taxed at 40%, will become 40. And the revenues, similarly, assuming that this is the same cost for the country B, then they will have a profit of 50 compared to 140 in earlier case. leading to a tax of 15. So in this case, you will see that the tax has become 55 in total. But if this is not accepted by country B, like I mentioned, that if they don't have an Article 9(2), then the situation will be that that country A will charge 40 and country B will consider that the cost is 110 only. Because understand that these adjustments, we are saying that it is not accepted by the tax officers, which will happen through a tax assessment couple of years down the line, by which country A and country B would have already filed their tax returns, and depending on when country B does, assuming that country B also does a tax audit, they have already conducted the tax audit on country B and process their tax returns with refund or whatever, refund or accepting their tax position. So this is already closed. So when this happens, this creates a lot of concerns. So it's important that corresponding adjustment is provided, because otherwise this will lead to as we mentioned, 82 of tax on a revenue of 150, 250. So which and which will be a very high tax impact, right? Because ultimately we are understanding that the profit will not be more than 140 for the group as a whole. So then ultimately, because 100 is at least undisputed cost and 10 is at least undisputed markup from country A, so the maximum profit is 140. But if the corresponding adjustment is not provided, then the tax may be 82. 82 out of 140 will be approximately 60% tax rate, 55 to 60% tax rate. So this is something which will defeat the purpose of taxation, and that's why the OECD suggests that you should have an Article 9(2) equivalent in your tax treaties. But again, they don't interfere too much and leaves it to the sovereign right of the countries to evaluate whether they want to have an Article 9(2) or not. Okay. Next. So similar with the permanent establishment, as I think in Indonesia also we have some specific rules related to the allowability of certain expenses, especially in relation to reimbursements for branches or permanent establishments, and the way the permanent establishments needs to be set up. So this article is somewhat similar to the other provisions, but applicable under Article 7 because it applies to branches, which some countries do not have do not consider it as a clear taxable person and gives them same rights as an entity. But it says that if a permanent establishment is accepted and it is said to be profits accruing to a permanent establishment, then the head office should allow the rights of permanent establishment country to tax that profit, and should allow as a corresponding adjustment. Right. So I think similar. Next. And similarly, like 9(2), the provisions of Article 7 are also different in different treaties, and so we have to be very careful. When you deal with the permanent establishment, you also look at the treaty provisions, and accordingly, those aspects should be kept in mind while planning your transfer prices. I think this is quite similar. The corresponding adjustments, just a minor tweak in language, but the purpose or the concept in OECD model as well as UN model is somewhat similar, in relation to the applicability of corresponding adjustment. Okay. Next. So we evaluated a couple of treaties that, like, for example, India-Indonesia treaty provides adjustment, same with Australia. And so usually now, while the treaties do contain, but, as I mentioned, some of the administrative issues do occur that how do you respond to a case of corresponding adjustment in practice? And we will cover this in the next slide, in the next one. So just coming from the corresponding adjustments, these are, few issues that we wanted to highlight. Do you think that the other countries will accept the correct? So this is for, I think this is for secondary adjustment. Maybe I will discuss it later. So we are saying that if corresponding adjustment is, applied, then whether this will be accepted by the countries, because if their tax audit is over, what are the provisions? Is it, how do you go through about those provisions? From our understanding, I think it will not plainly be routed through this unless you invoke special measures like mutual agreement procedures to effect that. And we have seen very handful of cases where corresponding adjustments are accepted by the other countries simply by having them in the treaties itself. So I think important if the groups decide to take the impact of corresponding adjustment, meaning that if, let's say, if you want to accept a higher taxability in Indonesia and wants to adjust that, then maybe you may want to consider approaching MAP unless the other alternatives are available. To our mind, it's difficult that there are other measures to get that kind of credit. Okay. Next. Yeah. So now we come to secondary adjustment. Go next. So what is a secondary adjustment? It is an adjustment ruling from primary adjustment, and it says that, let's say, when an adjustment is carried out, it also means that consideration has been passed on, which was also subject to other kind of taxes. So, for example, if in example, I'm carrying the same example from Hong Kong, Indonesia contract manufacturing example. Let's say if the Indonesia says that cost plus 4% policy is not accepted in Indonesia and they should apply a cost plus 6. So which means additional sales were required to be taxed in Indonesia, which has been, which has not been paid by Hong Kong. Then there are provisions which says that it can be considered as a deemed dividend, or, and subject to tax at the rate of 20% as per the Indonesian tax law. Now whether it is subject to the tax treaty benefit of lower withholding tax rates, this is also something which is an open question that we will discuss in the coming slides. And similar concepts, as mentioned in the OECD, are also reflected in the DGT regulations 22 of 2013 and Circular 50. So OECD does not have a very specific standing on whether you should do a secondary adjustment or whether you should not do a secondary adjustment. It leaves it open to the states to decide, based on their financial prudence and their legislative thought process, whether they want to do it. But it cushions that these should be carried out and not in a way that promotes, high level of economic double taxation. Next. So let's take the example of secondary adjustment before we come out at some problem statements related to secondary adjustments application. Same, suppliers give the subsidiary. So a subsidiary is in Indonesia buying from suppliers at 100, and then assuming 10% markup, sells it at 110 to the parent company. Parent company then on sells it to the customer at 250, assuming that they don't have any significant or other costs in executing the sales. Now, tax office in Indonesia says that the sales price should have been 200. Costs he accepts as third-party transactions, then assumes a profit of 100. Right? So, and in other case, and then The question is, if you give a corresponding adjustment, then the situation in country B changes from the first the first portion to the other one, where costs will become 200 instead of 110, and then effectively there will be a profit of 50 to be taxed. So you can see in both the scenarios, the taxability of country B varies significantly. If the cost is 200, then profits left is 50, and if cost is 110, then profits left are 140, leading to a difference of 90, which when multiplied by a tax differential of 10% has an element of 9 of uh, you know uh, 9 of debate, whether from a group perspective they can reduce their tax by 9 straight away. So when secondary adjustment is applied, then they consider the Indonesia do applies the same way, but it also says that if the corresponding adjustment is not accepted, or this is not implemented, then they need to tax the 200 in the point number 2. They will say that 100 has already been passed on by not charging as a deemed dividend, right? So this is something which is very tricky, and they will consider 100 as sales price, and then the 100 will be taxed as deemed dividend. So when you have a tax assessment, you will have a sales price adjustment, so which will mean the contract manufacturing sale, but then you will also have another adjustment for deemed dividend equivalent to 90, which is the difference between 200 and 110 at which the sales have been carried on. Now, is this tax applicable to country B? Yes. The purpose is that the Indonesian tax authorities assume that the consideration should have been 200, 110 is charged through invoicing, 90 is passed on through indirect dividend or deemed dividend. So then they say that they make a primary adjustment in the tax computation served by tax notices, but they also say that you should also pay, which you would have otherwise done if you had to facilitate 200 of transaction, you would have facilitated 90 by way of dividend, and you would have paid a withholding tax on dividend based on the applicable law. This is a very tricky situation. On one, the local regulations contain that dividend is to be taxed at 20%, right? But then if you use the word dividend, then dividend form of payment is also contained in the tax treaties. And the tax treaty says that if you can have a lower withholding tax rate if substantial of your shareholding is beneficially owned by your parent company or the shareholder. Because the purpose of having this is because they assume that if you do a lot of withholding tax, then ultimately the shareholder will have a very high tax rate, right? Because they are also including that in their taxable profits and have a tax liability to pay, because let's say that's why they use substantial shareholding, because when they have substantial shareholding, a large portion of their profits is also determined or also affected by the profitability of subsidiaries and their dividends. So, but this is done in the context of normal dividends. But when you have a secondary adjustment in the form of deemed dividend, can you say that Article 10 of the Article 10 applies? Can it be considered as a dividend in the form of Article 10? Because Article 10 is also says that you can apply treaty only when the beneficial ownership provisions are established. Now, assume a situation where, this is not accepted, that the parent company is the beneficial owner of dividend. Let's say they are a regional holding company and investment holding company. And we have seen, we are facing live cases where tax authorities are disputing that, some entity in Netherlands is not the beneficial owner of shares, then there is no respite of claiming a lower withholding tax rate, because as per the Netherlands treaty, the dividend withholding tax rate can be reduced from 20% to 5% if you are a substantial shareholder. But if you are not able to prove beneficial ownership, then this does not apply. Now the question that comes back is, because this is not this is not a dividend payment, not a primary dividend payment, it's a secondary dividend payment, will it be treated as the same dividend? It's pretty confusing, although the provisions say that the applicable tax law and regulations will the languages used in the regulations is that the law and regulations applicable in Indonesia will be applicable. Law and regulations also provide that wherever applicable, beneficial tax provisions of treaty will prevail. But is it that reference that we need to use? Is it a case of a dividend as per the law and regulations, or is it only a domestic adjustment? Can it also be said that every case of, because in a way, I don't want that this is the interpretation from tax office, although you never know, because they sometimes the tax officers take a very aggressive view. If they say that the adjustment is very high, like in this case, we are saying 10% profit and they are saying 100% profit, so which is very high difference. Can it also be considered as a situation of general anti-avoidance, a recharacterization of income? Because in that case, there is harmonized tax law regulations, recently regulated last year, which provides powers to tax officer to recharacterize the income. And when that thing happens, then you can assume that this is invoking of general anti-avoidance rules. And when general anti-avoidance rules are invoked, then the treaty benefits are not applicable. So these things can have a very high implication. So indirectly, with secondary adjustments, you should also observe your substance policy of the group, to which countries you are dealing with, how strong is the is the charge, is the charge that that in our case country B parent can defend. Like if the revenues are 250 and they don't make and they don't incur any significant costs, can that prove that they have substance, or they have done the marketing efforts, or have done substantial efforts to do a real marketing effort, improvise? While you can say that Indonesian entity is doing contract manufacturing supported by other things, but does it mean that we also need to look at the supply chain more closely? That besides, because usually over the years we have been looking at only, or focusing only on the transactions of Indonesia, but now tax offices have a lot of data by way of CBCR, assuming there are big companies, master files, to see what parent company is doing. While we can look at the facility in Indonesia, look at the kind of people involved, kind of infrastructure in place, everything, but does it? So independently, it may be a case for it may be a good case for just a contract manufacturing operation. Not a substantial gap arises from the way they have been organized, from their profit and loss statement, and from the way they are carrying on their business. But what if country B does not have the facilities to make a substantial add-on in terms of marketing effort to make that product go for 250? So these are very, very critical, challenges that one can anticipate in future coming from these provisions. Next. So I think this is already covered, the previous one. Yeah. And so this is similar to Article 36, para 6 of 55, which says that indirect profit distribution to affiliated entities can be treated as dividend, as I was mentioning, subject to income tax in accordance with the provision of tax laws and regulations. As I discussed, I mean, this is not a This can be subject to different interpretations. Will the language subject to income tax in accordance with the provisions of tax laws and regulations refer to the dividend provisions, whether it refers to applicability of tax treaty, to the extent it is beneficial to the taxpayer. So these are things that I think needs more clarification. Next. So just to recap, I'll also put some examples. Because usually the situations for secondary adjustment can, as we discussed previously in example, by way of contract manufacturing sales price, where the primary adjustment is on the sales price. There will be also cases where primary adjustment is on expenses. Let's say you are purchasing from, let's say, Hong Kong and selling to local customer. Then, similar to this, if your purchase price or the based on the profitability in Indonesia, it is determined that the purchase price is higher than what is prevalent in the local market based on comparable transactions, then can it also be considered? Because then I think that's a case of money going out. But in the case of sales price, can it be said that the money has gone out? That's the way of interpretation is quite different. One, it says that it should have been charged, and in case of primary adjustment of expenses, it is a case where they have more conviction that this has already been passed on. So one is the case where it should have been charged. Second is the case, that has already been passed on by way of higher purchase price. Right? Because both have implications on when the payment is due, which we will discuss later. Then the third is, we also note, just for the sake of audience, Indonesian provision says that, the transactions between Indonesia and, let's say, foreign affiliate, maybe parent company, are subject to VAT in case the services, let's say, if it's in the case the services or the consumption of the activity has happened in Indonesia. Now, assume a case where there is a foreign parent who has majority of customer base in Indonesia, and Indonesia entity is only acting as a cost plus entity. But ultimately, majority of the sales of the group is contributed by Indonesia. Because, companies have different views whether they should treat the invoice flow from Indonesia to their parent company as subject to VAT. Because in most of the cases, there is a pushback from the management that since this is a transaction where invoice flow is happening between Indonesia and, let's say, US, then there is no direct case for attributing VAT, because the customer base is separate, but we are consuming that service. It's not the customer consuming the service, we are consuming the service. Now, it's an interpretation which has been tested differently by different tax officers. But what if if the tax officer applies VAT on those circumstances? And we have also seen cases where tax officers considers that this VAT is a compensating adjustment. It should have been built in your prices. And then they are also charging secondary adjustment on VAT itself. Because the purpose of secondary adjustment is the money which has been passed on or said to have been passed on. But if VAT has not been charged, is it fair to say that secondary adjustment can prevail on VAT? Because this is a compliance related cost. It is not a cost of business, that has been implemented. Because VAT would have been passed on to the government. So it's not something, which can have a direct implication in that way. So, again, not very clear on, we assume that there should be a more liberal interpretation applied by tax authorities on these kind of cases. Then fourth is the GAR application, as I discussed at length in my previous example. what if the corresponding adjustment is not accepted by the other country? So now, interesting case. What happens, let's say, if Hong Kong accepts cost plus 6, additional 2%, will secondary adjustment still apply? Again, because I think it depends on what is the framework based on which the secondary adjustment is applied. Because the rules it should be covered by detailed circumstances. Is secondary adjustment applied only if a primary adjustment and is applied and additional adjustment is not accepted by the other country? Or will it apply as a default rule? Just take an example. Hong Kong says, okay, cost plus 6 is okay, let me pay another 2%. Will you still treat it as a secondary adjustment in the hands of Indonesia? I mean, the answer is not very clear, but then it defeats the purpose, because Indonesia is focusing on cost plus 6. Do they essentially need a dividend if Hong Kong accepts to cost plus 6? I think there are more clarifications required on this issue. What if the tax officer starts to say that because the secondary adjustment is applied, and he targets it back to the payments when they were released, or the sales, because the withholding tax provisions in Indonesia are based on due dates. The relevant articles, when it comes to foreign payments, it says that withholding tax provisions or withholding taxes are supposed to be deposited when the due date of withholding tax arises. So in case of secondary adjustment, will that be applicable? Because I think then the penalties will also flow, because if you do it at the time, let's say you have your tax assessment is done 1 year down the line. Let's say at the time of SP to DK, you agree that, okay, I agree with this, and I'm resolving the issue, paying the secondary adjustment. But will there be penalties also at the rate of based on the due dates? So I think this is again something which is not clear yet. We can apprehend that the tax office can go in that direction, which will be very drastic for the industry, and can increase the tax burden significantly. But that is something we expect more clarifications to come in. Next, London. So I think this.
Sorry, Salo.
Yeah.
I think we will, before we go further, there are questions from the floor, Salo, from
Okay.
Sunar from Sunar from Politama. This is related to the previous discussion that we have discussed before, related to related party. Yeah. So there are two questions, so I will read it for you. The first one is, for non-multinational transaction, currently, what is the tendencies or focus from the Indonesian tax office to evaluate or audit the transaction which is done between related parties that both are Indonesian taxpayers, both parties are under the same final non-final tax regime? If such adjustments are made, how the corresponding adjustment is made to the other party, of which the other party is not being audited by the Indonesian tax office? Do you want to answer this directly, or I can read for the second question, Salo?
Yeah, I think I'll just quickly respond to this.
Yes.
So I think it's a valid question, and I would even say that the corresponding adjustment from a domestic framework, I mean, unless you have one of the entities enjoying special tax incentive, then I think the concept of corresponding adjustment in domestic tax, I don't know what is the if you make an adjustment, then I think that should be reflected fine by the tax office. But again, as I mentioned, you will also have to look at whether the secondary adjustments will also be considered while you accept those things, but you will also have due date scenario and maybe corresponding plus secondary combined, you may still have some implications. And just to the sensitivity or for non-multinational, because domestic transfer pricing provisions are still applicable, although in many countries the domestic tax transfer pricing is reserved only to cases where some of the entities or the transactions are happening with the group entities who are enjoying special tax incentives. So unless if all the entities in the group are facing same tax rates, many of the countries have abolished the domestic transfer pricing, but that is not the case with Indonesia. So technically you can still have some issues, but because principally, you may not have a tax impact overall. Combined with the two entities, it will be a zero tax impact, a zero sum game. But yeah, from a compliance perspective, it is still required. So unless Indonesia modifies the domestic transfer pricing rules and provides that the transfer pricing is only required to be analyzed between the entities which has special provisions, then only it should be applicable. But for Indonesia, considering that there is a lot of impact of investments coming from outside, and Indonesia has been providing tax incentives to oil and gas, manufacturing, metal sector. So you anticipate that exemptions will continue. So domestic transfer pricing provisions are also expected to be to stay, but I think the rules can be modified. Hope it answers.
Yeah, I hope it answers. Bu Sunar from Politamaya. Maybe I'll go with the second question, yeah, Salil.
Yeah.
In case where the transaction loan agreement made between ABC company and XYZ company, which are previously categorized as independent parties, and then during the period of loan, the parties became related through share ownership. And then does the loan agreement, which are still in force, still be considered as arm's length transactions, since the agreement is signed when the parties still act as independent parties, or does it mandatory or need to be reviewed by conducting TP study?
So I think it's a very tricky question. I'll tell you, although it's a little digressing from this topic. Previously, I think decades before, some of the companies used this approach that they had a contract with a customer or with a supplier, which was initial to acquiring some substantial ownership in that company, and the prices were set in that year. And then the company adopted those prices in the future years. And the justification was because when they were not part of the group, it was the same price. So when they became part of the group, it is the same price. So it should be serving as a cup. But this is where the knowledge on transfer pricing needs to be applied correctly. That cup is determined on a particular date, price, and everything. So when I assume when you say that when the transaction happened, the transaction was a third party scenario. So effectively you are trying to do a price based comparison. But CUP is influenced by comparable uncontrolled price method, is influenced by conditions prevailing as on the date of transaction. So you will have to demonstrate that the conditions between ABC and XYZ prior to they becoming part of the intercompany relation are same and exercised in a consistent manner. If you are able to do that, then it's fine. But otherwise, it needs to be evaluated. And related to the second point whether it needs to be reported, because if you have a financial arrangement for part of the year, the interest will accrue to certain part of the that year. And Indonesia does not provide they do provide specific transaction-wise threshold, but they also you have to manage the thresholds on an overall basis. So if you have an exposure, then it is subject to arm's length pricing test. So, depending on the thresholds, you may have a technical, requirement of whether to comply with arm's length prices. But this is more from a documentation perspective. But I believe that even if the thresholds are not met, then also you may be asked by tax office to prove the arm's length pricing. Does it help? Does it help the answer?
Yeah, I hope it answered. Yeah, Yusunar. If there is need further clarification, you can contact us directly later, Yusunar. Okay. And also, Bapak Ibu, if you have any question, you can drop message to the chat box, ya Bu, atau Bapak.
Okay.
Okay, Salul, maybe we can continue for
All
the
right.
comparability analysis.
Thank you. Just give me 1 second. Sorry. Yeah. Okay, so here we are discussing some of the adjustments which we have seen in practice across other countries more than Indonesia, and which are very relevant in the context of Indonesia also. And though they are there, but sometimes the data does not support. But these can be important in the context of contract manufacturing or other major operations that Indonesian entities carry on. So one is the working capital adjustment. Next slide. Yeah. So even OECD and countries across the world recognize that while you do comparability with comparable companies, they may have different debtors aging, suppliers aging, and all of these may also impact your pricing depending on where you are operating. In some countries, so it also depends on how you are structuring your business. Is it through how leveraged is your position? And those factors also have an impact on the pricing. So usually if you see in your balance sheets that receivables position and inventory position are not in sync. So you have a higher exposure on supply side or receivable side, and that is something that you don't find in comparable companies. Then it's a case of adjusting those prices to even out the gaps and do a more concise comparison. Next. Just to give you an example, let's say your trade receivables are 45 in year one, inventory is 35, payables 30. So your effective working capital is 50 of receivables. And then this is 25% of your sales, which is something which goes on to say is that the sales activity is somewhat a dominant activity of your business, because 25% of your sales remain in receivable position, right? Whereas in the case of comparables company, let's say if it's lower than 20%, then you can assume that the intensity of receivables that they are exposed to is lesser. So effectively, you could see that your pricing, your because you have in the tested company, because you expect that the customers will pay later, so you will build some add-on pricing in the sales price of the customer invoicing, compared to a situation where you have lesser receivable position, which is pretty natural, because if in industry it happens very quite often that if you agree on a prepaid basis, then the prices are different. Whereas you agree on a postpaid, let's say, contract date plus 6 months, then the prices will significantly vary, because then there is a cost of 6 months that comes into play. Next. This is how you should be able to adjust. Let's say, assuming that you are a distributor, then you should adjust this 7%, as I was giving an example, to the interest rate prevailing at which the loan may be taken, depending on your capital situation. So this increases your pricing by 0.34% compared to the comparables, and accordingly you should make working capital adjustment to make a effective price comparison. This we have seen less in practice and less adopted by tax offices, but not that they are totally averse to it. Majorly, you don't find comparable data in for companies very easily. Depends on the comparable companies you are picking up from. Like for example, many of the Japanese companies, you don't have complete data or comprehensive financial statements available. That may be the case with many comparable companies. But if you have that data, then this is something that you should leverage, because the situation of a contract manufacturer will be different from other manufacturers, and you usually have to make adjustments. Same with distribution companies, manufacturing companies, and service companies, depending on, because you don't find too many comparable companies. And then in order to test the intensity of which they are operating, these kind of adjustments are really helpful. This is pretty common. The reason we picked up in this presentation is because despite being so common, it is not very frequently applied in Indonesia. But just to, price. Next. So with this first part of the presentation we have covered, I'll quickly discuss some of the other experience we have faced with the tax authorities on COVID-19. Some of the other methods that have been prescribed by the HPP law and what it holds for us, and the MLI update from Indonesia. Next. So this is something very interesting. Indonesia to date has still not prescribed how the tax authorities are supposed to deal with COVID-19 impact if the taxpayers are, carrying some COVID-19 impact on their transfer prices, and how the tax officer is expected to deal with that. We had some interactions during tax audits, and we started off with some technical questions also, that why do I look at OECD guidelines or some other guidance, and why should I not treat it as normal, because Indonesia has not provided any specific regulation for adopting the COVID-19 guidance. But then sometimes the tax officer, that depends on the tax officers you are dealing with, and then you have to explain that if Indonesia has not provided, then there is no other way. But we cannot shut our eyes to the fact that the company is impacted by COVID situation, and that is reflected in their cost, sales, and other pricing elements. So some of the things that you could probably look at is when you do a COVID-19 impact analysis, look at the guidance provided by OECD. The primary issues that they covered is related to comparability, that you can make comparability adjustments, depending on the industry and depending on the, kind of business situation that you faced. And with empirical data, you can make those adjustments handy and, back up with substantial data. And there may be companies who are facing losses and, primarily on account of COVID-19 costs. And how do you identify those costs? How do you document those costs? And this is also very important because OECD acknowledges that these COVID-19 impact costs can be allocated to different group entities. In fact, COVID-19 as a measure of COVID-19 guidance, usually we see that limited risk entities should be enjoying a fixed markup, fixed cost plus structure, or fixed sales margin. But OECD has acknowledged as part of COVID-19 that even those structures will undergo a change, because this is a massive change which has disrupted the supply chain and value chain across the group. So you may also find that limited risk companies who have reported a consistent cost plus or a fixed sales price margin may also alter their policies to allocate for the allocation of COVID cost, because this is not part of routine business activity which you expect your principal entity to bear, because they did not anticipate that you will have certain costs in relation to employees, related to PPE kit, related to the operating measures, the uh, sanitization, work from home infrastructures, so many other costs, operating hours, need for overtime, prices of oil, steel, all these things. So if these are key raw materials for you, then this will impact your pricing, and OECD acknowledges that these could be considered. The government assistance programs, and even if you have entered into an APA, then the APA can also be adjusted for the COVID-19 impact that you have suffered on your cost base or sales base as a measure of the pricing agreed. So we are dealing with a lot of manufacturing and distribution companies that are impacted through COVID-19. So we are doing a lot of measures to make sense of how they have responded to COVID-19. There are sometimes they are entering into long-term agreements where they have committed a sales price, but on a cost side they are directly affected by the COVID-19 raw material shoot ups, the labor cost shoot ups, and so many other things. So which they don't have an opportunity to revise their sales price in a quick span of time. So helping them adjust their pricing policy to the impact of COVID-19 in a more systematic way. Then just for example, very interesting case. We were working on a rubber company, who was manufacturing, who was a contract manufacturer of rubber. For number of years we were using comparable companies, but in COVID-19 we are rejecting rubber companies who have a portfolio of using rubber for manufacturing gloves, which are used in in the surgeries, because the hospitalization has increased. So while the other rubber companies have gone down in COVID years, the companies who were manufacturing rubber and supplying to companies who were using them for as part of PPE kit, or um, the sanitization gloves, they have reported a totally reverse profitability. So by explaining and being cognizant of the fact that all businesses differ, and the strategies that you applied in the past may not apply in future. Similarly, with so many companies who are making from many companies, their key markets were in China. So if you have a very high supply from China, let's say for example, you are procuring machinery from China, you are importing steel from China, sourcing steel from China. The prices have gone up significantly, but since you have entered into long-term relationship, sometimes you are procuring it from them. Then coupled with the transportation, because China has the longest impact of COVID-19, even in the way they operated. So the transportation cost, freight, etc., everything will become different when I import from China compared to when I import from, let's say, Taiwan in the COVID years. Similarly, from the sales side, if your majority of customers are in a country which is impacted by COVID, and your products are in discretionary spending, then it may be impacted in different countries differently. So you have to take the exposures, make adjustments, and do a lot of impact analysis, depending on looking at the framework of your contract, how long because you cannot, as a business, when you are dealing in a B2B scenario, business to business scenario, you cannot change your contracts overnight to impact the COVID-19, because you have and none of the businesses predicted that COVID will last for so long. So they might have, some of them have been very proactive, and that again depends on the management style, depends on the way their operation style, management policies, everything. Some of them will have contracts which says that, the prices will be, which will cover for changing the contracts, uh, terminating the contract, entering into new contracts. Some contracts may have penalty clauses. A lot of other clauses may be there which will propel you for buying higher, justified by business reasons. So all these things you have to take into account while doing your transfer pricing analysis. And similarly, we have also seen that how do we make a sensible sense of the business operation. We also look at the budgets that the company prepare, if they are prepared in a systematic way, and backed by logical explanations that how they have budgeted their performance, even for contract entities, contract manufacturing entities, distribution entities. How do they budget? What are the parameters of costing, pricing, etc.? How do they take, and how then they will be impacted by COVID? Like I gave you the example, the steel prices were impacted significantly during the COVID times. And then if steel is a raw material for you, oil is a raw material for you, then you can anticipate that it may have very varying, impact on your businesses. Because sometimes your input is commodity impacted by COVID, but your output is not. So you cannot translate the costing into your sales product easily. So all these things have to be very systematic, and you have to look at it purely as an economist on how the businesses will be suffered. Also requires deep understanding of the business and industry, and how businesses are growing, how business policies, how different businesses are reacting and adopting to the policy changes. So all these things are very relevant and very dynamic compared to previous transfer pricing arrangements for Indonesia, purely because it's a manufacturing hub for many countries. So sometimes we also look at expanding the years to alleviate the effect of the pandemic. This is something that we are taking from, because Indonesian regulation says that you should use multiple year analysis to even out the effect and consider 3 years as a practical norm. Sometimes you are able to get a more sensible sense by expanding it to 4 years, or depending on the kind of comparable data available. So this is something that we have been using different approaches. Sometimes we look at it's difficult to compute, but let's prepare a report based on budget, and then when the actual results come, we do updation, a proper updation that and this is something that is supported by OECD also, that you can update and defer your complete documentation to the actual results. So this is in contrast to the ex ante that Indonesia follows, that transfer pricing documentation needs to be an ex ante basis. You can prepare an ex ante and can support with ex post, especially for businesses impacted by COVID. And then use of more than one TP method, because sometimes, and this is also again provided by OECD also, not only during COVID, but previously also, that sometimes the businesses are very dynamic, and you may need to employ more than one method to ensure the sanity of the results obtained. Then we also do some very meaningful activities, like we also see that to even out, how do we factor out that these companies should be otherwise acceptable but are rejected due to COVID? Because we see that companies are making steady profits, but in the COVID years, they are making steady losses. So we don't reject those companies. So this is again, no rules. We are applying a lot of systematic analysis to it, and we are constantly sharing our knowledge, because Indonesia plays a very crucial role, and we are also, evaluating these positions with RSM global offices. So this is a important thing that, Indonesia needs to take into account, because being directly exposed to so many manufacturing and distribution operations, so many fixed cost arrangements that they have employed in the past, and some of which may be, directly or indirectly impacted by COVID-19. So these are important considerations that businesses should keep in mind, because the tax audits will remain open for 4 years. Then, you should adequately prepare for any challenges that you may have exposure on. Next.
maybe because we are
Yeah, we are running short of
discussing
time.
the
I will do 2 minutes of
there's
the slides, and then I will take up the questions and close.
okay.
Okay. Then this is again, as I was mentioning, OECD has prescribed that there are certain circumstances where it becomes very difficult to employ a clear method, and this is also something that Indonesia has also adopted by acceptance of use of other methods like business valuation, comparable uncontrolled transaction. Like we usually say that royalty when we use a benchmark of when we use a benchmark through database, we call it comparable uncontrolled price, but technically it may not be a price comparison. It is a transaction comparison because royalty is charged as a percentage of sales. So that's why I think it's more of clarificatory in nature that Indonesia has provided that you can use a comparable uncontrolled transaction method and some other methods. There are some cases where it becomes very difficult to benchmark transactions. Let's say where business as a whole is transferred, where intellectual property is transferred. Then you have to do business valuations on what is the key thing that is that is transacted, and that's where maybe this is linked to the next slide. We go to the next slide, where these amendments by Indonesia in Part 255 are making sense to have the provisions for applying a comparable uncontrolled transaction method, tangible and intangible valuation method, because sometimes you may have a valuation. This is a common question that comes from client that we have an external valuation. Can we use it for benchmarking the transaction? So as a transfer pricing practitioner, I always say that the answer is yes and no. Yes, if because the transfer pricing has its own provisions. It says that even if a valuation is done by an expert, I cannot do a valuation of something which is very intangible because I'm not expert. I don't have expertise of that. So I will rely on expert, but I will test. Then I become a pure auditor and will check what are the assumptions applied by the valuer. Is the valuation report systematic? Because sometimes it's a one-page valuation report with no parameters referred as to how they determine, let's say, a share price value or a IP value or a asset value. Then how do you know that what is the useful life you have taken? What is the residual value you have used? What are the other factors of valuation that the valuer has employed? So as a transfer pricing practitioner, we still have a role to find out whether the techniques or whether the principles of valuation have been applied correctly, which methods have been used, is it supporting? For example, a fair value method may be more reflective of a business which has foreseeable sales value of their products. But if the business is a dooming business, maybe you use asset, the book value of your assets. So again, it depends on the use of valuer approach coupled with systematic audit techniques, which will be the way that the tangible and intangible assets valuation and business valuations will be reflected, coupled with the business sense and management view on how they view at the transactions. And this is the way I think the other methods are expected to be applied in the territory of Indonesia. And this is something which is again similar to the global guidance and the practice observed in other countries. Next. But the areas in which this is helpful is, for example, sometimes we use commodity based index for pricing, or let's say doing a transaction based on data available in public domain, but you cannot apply it because a cup method is usually an actual pricing transaction. But if you you will need to have actual executed transaction to benchmark that. So for example, you cannot just use a quotation from bank on the interest rate and use the same interest rate with your parent or subsidiary company. You need to evaluate how the quotation came, because you can get a favorable rate if it is an unexecuted transaction based on your banking relationship and other things. So you need to see that what are the ways in which this rate has been arrived, is this condition similar to what is there? So then you can make, then you cannot call it as a cup method, but it is more of a, a method which meets the other method criteria, because the principles of fair pricing or arm's length dealings have been observed. But since it is not an executed transaction, it is covered under other method. It's a welcome provision from Indonesia. Next. And then this is the multilateral, instruments that has been, ratified by Indonesia, as on date. And I think we may want, time is running out to speak on each of these individually, but multilateral instruments is a way of, incorporating the updated provisions directly into the treaties without, signing separate treaties. As I mentioned in my slides that, prior to 1963, the treaties did not have Article 9.2 because OECD did not have. So it is anticipated that 90% plus countries may not have a 9.2 provision in their treaties. But then using MLI, if you want to use that, and if both the countries agree or based on, the provision of 9.2 to be adopted, this is something that with one sign you can implement directly into the treaties without signing separate treaties, because treaties can take years to sign. And just as an example, and similar to this, there are multiple provisions governing various facets of the business transactions and dealings. I think with this, I will conclude my presentation, and thank you all for joining. And I'll probably take some questions as we still have few minutes. Nandu?
Yeah. Okay. Thanks, Salil, for the comprehensive discussion. It's a very fruitful discussion. Yeah, I mean, the topic itself regarding the international tax as well as transfer pricing. And now we come to the question and answer session. Bapak dan Ibu, if you have any question, just put it in the chat box. Yeah. But I see one question from Pak Iwan, yeah, Salil, from the chat in the chat box.
Okay.
For Indonesia TP perspective, if we have sale and purchase of finished goods, is at cost at 10% markup, is it okay? Or will Indonesian tax office insist a 10% markup? And this is related to contract manufacturing.
I didn't understand if Indonesia, from an Indonesian TP perspective, if we have sale and purchase of finished goods, okay, at cost plus 10%. So what is the markup on? Is it, so the transaction is that Indonesia is a distributor who is purchasing contract manufacturing. If Indonesia is a contract manufacturing, then I'm assuming they are, but then why will they purchase finished goods?
They have a transaction of sale and purchase finished goods, yes, at 10%.
Purchase of raw materials? Do you mean purchase of raw materials, or because Indonesia is a manufacturer, right?
Yeah. So basically it should be raw materials because contract manufacturing.
Yeah. So if Indonesia is a, because I think the principle from transfer pricing is that you have to evaluate both the transactions separately. The purchase price is to be evaluated separately and sales price has to be evaluated separately. We cannot, this is the primary aspect where, where you have to apply a transfer pricing, because as, you will try to firstly see that, is this raw material common? Is it a commodity? What kind of raw material you are buying? And if there's a price-based comparison, then you would try to, test your purchases with a price-based comparison. And maybe your output is not a commodity. And then you may want to apply you test the markup on the sales side. So first of all, the principle is that you have to evaluate transactions separately, and only if they are interlinked, then you can merge, and then you have to see. But plainly saying 10%, maybe we cannot say with with clear results, because as I discussed, Indonesia, we need to look at what are your comparable companies. Sometimes, as I mentioned in the presentation also, some businesses may even if you are a contract manufacturer, if your purchase price of materials goes down due to whatever reason, and you are able to maintain your sales price, then you will have a higher sales price. That is something that can be the factor with comparable companies, and could be vice versa. So we have to look at each year separately. So cost plus 10 may be high, cost plus 10 may be low. So in every year, we have to do a benchmarking to find it out. I hope that answers, because it's more of principle that that we have to exercise while determining. So as a number, cost plus 10, cost plus 15, cost plus 5 is something that we cannot comment without doing a comparable benchmarking, which is dependent on economic and commercial circumstances faced by you during the year. Same with your comparables, and then you can evaluate whether cost plus 10 is workable or not. And that's why companies evaluate their markups every year as a best practice.
Yeah, I hope it answers ya Pak Iwan regarding your questions. Even the best answer will require further analysis ya on the separate transaction itself. Bapak Ibu, apabila ada yang memiliki pertanyaan lebih lanjut, boleh disampaikan. Dan saya juga mengingatkan kepada Bapak Ibu peserta untuk tidak lupa untuk mengisi form feedback ya yang sudah di-share oleh tim di chat box.
So I think there is a question, Landung, from RSM.
Okay. Oh yeah.
Is there a local tax regulation that we can leverage as a reference for the use of LVAS as tax harbor? I mean, is it to do with the safe harbor? LVAS means? So I think, but I'm not very clear with what is the meaning of LVAS. Maybe if you could explain.
Maybe it's a low value added service.
Oh, low value added service. Oh, sorry.
Yeah.
Low value added service, with the acronyms. Okay. There is no guidance in Indonesia. And in fact, principally, Indonesia has no concept of low value added service safe harbor. This is prevalent in most of the countries, and even OECD through the BEPS guidance has also mentioned some of the low value added services, the category of services depending on the functions performed. But Indonesia per se does not have any safe harbor rate. OECD has a 5% rate, but using it in Indonesian context can be challenging.
I hope it answers, Bu Ardesti from FAS ya, Bu. Service. And Bapak Ibu, misalkan ada pertanyaan lebih lanjut, boleh disampaikan melalui chat dengan menyebutkan nama dan juga organisasi. Masih ada. Oh, udah selesai waktunya. Yeah, I think the time is up ya, Salih. So
Yeah, I think there is one more. Pakiwan is saying, "Can I have this record?"
oh ya.
I think. Did you mention Landung?
Ya. Ya, untuk recordnya Pak nanti akan di-upload di YouTube RSM Indonesia ya Pak ya, Pak Iwan. So basically all of the record regarding webinar by RSM Indonesia will be uploaded to the RSM Indonesia YouTube channel. So Bapak Ibu, if you need, to research again what we have discussed, you can refer to the our YouTube channel. So find other record for the other webinar also.
Yeah.
Okay. And I think if I may conclude Salil from our discussion today, because it's very comprehensive and it's interesting topic to discuss. And I would say that at this moment, I mean nowadays the application of arm's length principle is not only about the compliance, but it is more about philosophicals of business, because again the application of arm's length principle will take place on the supply chain of the multinational enterprises of the companies, and also with the use of references, the OECD and then the UN model. It provides actually guidance on how to use that kind of implementation. And of course, it it needs to go back again to the sovereignty of each country using the relevant regulation provisions that is issued by the relevant ministry. And it will, we believe that it will provide the same level playing field between the tax administration as well as taxpayers. And regarding the corresponding adjustments, it is also a very interesting topic because it is a way to eliminate double taxation. And but again, regarding the secondary adjustment, it needs to be back again to the sovereignty of each country. Dan kami rasa cukup sekian Bapak dan Ibu apa yang dapat kami sampaikan, dan saya mengingatkan kembali sebagai moderator untuk Bapak dan Ibu mohon untuk mengisi form feedback yang sudah disampaikan oleh tim di dalam kolom chat box, dan nanti setelah Bapak dan Ibu memberikan atau melengkapi kolom feedback tersebut nanti akan dapat disampaikan atau dapat diakses atau di-download mengenai materi atau slide yang sebagaimana disampaikan. Dan apabila Bapak dan Ibu juga memiliki pertanyaan lebih lanjut atau ada hal-hal yang mungkin masih belum jelas atau ingin dipertanyakan, kami dengan senang hati akan memberikan pendampingan atau memberikan asistensi kepada Bapak dan Ibu. Jadi kami membuka pintu selebar-lebarnya bagi Bapak dan Ibu untuk pertanyaan atau hal-hal yang masih perlu diklarifikasi lebih lanjut. Silahkan menghubungi kami melalui email. And maybe Salil, for the last time, you may want to say something.
So I think I want to thanks the participants for joining us for this topic, because this is still an evolving topic in Indonesia. But I just a broad line that the world taxes is moving from compliance to value creation. So now your cost plus may not be a cost plus in the eyes of tax office with so much of data, use of data engines, tax engines, smart technologies, risk-based indicators that they are using. So it's high time that companies should start evaluating what they are contributing, because the focus has moved from functional analysis and transfer pricing to value creation. So that's why, you will find that a lot of recharacterization focus is there in Indonesian tax office in the recent years, that they are giving sweeping powers to tax officer to apply general anti-avoidance and recharacterize the income based on how they, evaluate the case. So we should have safeguards in evaluating and looking at not only how Indonesia is doing, but should also look at and proper use of master file by seeing that what are their transacting parties doing. As I gave in the example, maybe the tax officer may also be interested in knowing that, okay, Indonesia is doing a contract manufacturing and a cost plus 10 is sufficient, but is the entity with which it is dealing is doing what is supposed to do? And because these beneficial ownership issues will start coming from secondary adjustment. So secondary adjustment is like a double whammy and a very big weapon in the hands of tax office to which can lead to very challenging consequences. That's it from my side. Thank you.
Thanks, Salil. Baik, terima kasih Bapak dan Ibu sekalian sudah menghadiri webinar kali ini. Dan kami rasa kami akan mencukupkan webinar pada kali ini. Sekali lagi terima kasih, dan saya selaku moderator mewakili RSM Indonesia meminta maaf apabila ada kesalahan kata atau ada hal-hal yang kurang berkenan di Bapak Ibu. Dan sampai jumpa Bapak Ibu di webinar-webinar dari RSM Indonesia di pertemuan selanjutnya. Selamat sore.
At RSM, we have over 40,000 great minds that take the time to find out what makes you and your business tick. Our audit, tax, and consulting services are designed to help you move forward with confidence, but it's how we do it that sets us apart. RSM's experts take time to understand what matters most to you, which means you receive advice that goes beyond your expectations. What you'll notice is the lengths our people go to understand the hurdles that stand in your way, and then to find innovative ways to help you jump over them. That's the value of RSM. That's the power of being understood.